Hi everyone, we'll just be giving a few minutes before we kick off the masterclass. So around 11:33. Thank you. Hi everyone, welcome to the first masterclass hosted by OMI and ASABA. My name is Nita and I'm a manager in the short-term practice at Deloitte. I'm a member of ASABA and Actuarial Women's Committee. Old Mutual Insure and ASABA have entered into a partnership to increase the number of actuaries across the short-term insurance sector. In order to make the short-term insurance an attractive actuarial practice area for diverse candidates, they have embarked on several initiatives that we will be rolling out in the coming months, such as networking events, short-term industry updates, and workshops. Today, we have our very first masterclass led by Ron Richman. Ron is the Chief Actuary at Old Mutual Insure and is a Fellow of the Institute and Faculty of Actuaries and the Actuarial Society of South Africa. He holds a practicing certificate in short-term insurance as well as life insurance from ASA and a Master's of Philosophy in Actuarial Sciences with distinction from the University of Cape Town. Ron chairs the Actuarial Society of South Africa's ERM committee and is a member of the Aston board as well. Before I hand it over to Ron, just want to say that he would like for the session to be interactive, so please type all your questions in the chat and he will be happy to respond to them as he goes along with the presentation. Over to you, Ron.
Nita, thank you so much for that great introduction, and thank you to you and for all of the organizers of the event for putting this together. So what we'll be talking about today in the first masterclass that we're going to be giving is reserving with the Cape Cod Method. And this is my favorite reserving technique for reserving for IBNR claims in short-term insurance. And hopefully by the end of it, we'll have had a great overview of exactly how the technique works and some of the more interesting and advanced ways of applying it. I suppose what the idea of a masterclass is to share experience, share views of what works in practice and what doesn't work in practice. And what I'm going to try to do throughout the talk today is really just give everyone attending a taste of how I like to apply this method and also what I've seen to work. And then what we'll try to do in future masterclasses is find other topics in short-term insurance, whether it's reserving or pricing or capital, and use and provide masterclasses on some of those. So what are we going to look at today? We'll give a quick introduction to short-term reserving for anyone who hasn't done this in practice before. We're then going to go on a quick journey from the chain ladder method, which is the most basic and well-known reserving method, to the Cape Cod method, which is really what today's talk is about. We'll see some ways of modifying the Cape Cod method to allow for special circumstances. We'll look at how to perform an actual versus expected analysis, and then we'll look at some of the more advanced ways of using that actual versus expected analysis to parameterize the Cape Cod, and even look at some machine learning methods and how you can apply machine learning perspective to the Cape Cod methodology. So let's go. So reserving for short-term insurers is one of the main activities that actuaries perform within the short-term insurance sector. And the way this is done is by applying specialized techniques to estimate reserves. The major focus is normally on incurred but not reported claims, and we'll talk through exactly what an IBNR claim is in just a little bit. But the main thing to remember is these are claims that have already happened and that still need to be settled. So they have been incurred by the insurer, but they're not necessarily fully reported, and therefore we need to hold back funds to make sure that we can pay these claims. If you look at the overall insurance industry balance sheet, you'll see that there's a significant amount of what otherwise would be capital that's tied up to support the industry's IBNR reserves. And these reserves can create substantial risk to your insurance industry. So if reserves themselves are misestimated, or if the environment changes, which could lead to higher claim payouts than you might have thought at the time that you raised the reserves, these can cause major issues for individual insurers and can also cause major issues for the whole sector. So let's just run through the typical lifetime of a claim, just so that we can all get a feeling, if we haven't seen this before, for how IBNR claims arise. So the first step of an IBNR claim arising is that someone's going to take out cover with an insurer, and cover is going to be granted for some risks. This is the first arrow on the bottom left-hand part of the slide. What then is going to happen is that a claim is going to occur, and this claim will be due to a covered peril under the policy. So if it's a property type of policy, maybe a car gets damaged. If it's a liability policy, maybe there's an incident or an occurrence that leads to some sort of legal liability. The next stage, and this is where things start to get interesting, is that it can sometimes take a long time for a policyholder to actually become aware that there is a claim. And this is the first place that a delay might arise between the occurrence of the loss event and this actually becoming a claim. So why could this occur much later? You might be on holiday and you didn't know that there was some damage sustained in your house. Or if it's a liability claim, sometimes the effects of those liability claims only become known much later. So if you think of the famous long tail case of asbestos, when people got injured by asbestos in various different occupations, they often only started exhibiting symptoms many years later. And a big topic along these lines that's been discussed recently is the case of workplace-induced hearing loss. You might only realize that you actually have a liability claim quite a while later. What then happens generally is that the policyholder will contact the insurer and say, hey, there's a claim. And at that point in time, you'll raise some reserves, and this would be the first instance where you need to rely on your IBNR reserves to fund these claims. And then what happens, and this can take a really long time, is the quantification of that claim. This can sometimes involve a lengthy court process, and another place you need to rely on your incurred but not reported reserves is to fund any further payments or further reserves that need to be raised by the insurer. And then after this is done, there can be a further delay in terms of actually paying the claim. So you can see we've given a description. Most claims in South Africa are settled much more quickly than this, but there's definitely lines of business where you can have all of these stages. And because of these long delays, an insurer has to make sure that they're holding enough funds on the balance sheet in order to pay claims. So how do we actually reserve for claims? So the quantification of the reserves to back IBNR claims, as we've mentioned, this is the typical actuarial thing that actuaries do for short-term insurers. And what are some of the key principles? So you generally want to aggregate multiple claims events so you can derive the patterns with which claims occur. When do they generally come in? When are they generally settled, etc. Another key principle is you want to differentiate between different cohorts of claims. And the reason for that is different cohorts of claims often behave differently, but also more importantly, to start seeing a pattern with which claims are getting reported, you often need to look at the cohorts and how each cohort developed. And that's exactly related to the next key principle, which is you want to differentiate between claims development at different stages. You generally measure the stages in terms of how long this claims cohort has had to mature. So what you do is you aggregate all of your claims developments into a claims triangle. We're showing an example claims triangle on the right-hand part of the slide. From top to bottom, you've got your cohort axis, and this generally relates to the different accident years or the different years of loss in which claims occurred. And then the axis running from left to right is the development axis. This generally relates to transaction time, where transaction is claims payment or change in reserves relating to a particular claim. And this is very useful for anywhere that you need to perform analysis where your development happens over time to different cohorts. So we've mentioned insurance claims. You often find these sorts of triangulations in other areas as well, such as if you're looking at the number of infections versus of a particular disease versus the number of reported infections. This is very useful. And then you could also have a look at the number of your loan book that are still current. So if you have got a big consumer loan book, you can start to triangulate the total number of loans that are expected to remain current, and that can help you with credit risk. So this isn't just a short-term insurance thing. This is quite useful in a number of different areas. So the triangles that we're going to be looking at throughout the presentation were provided by a multinational insurance company 2 or 3 years ago for a project that we did. This is a liability triangle. And some of the characteristics you can observe, if you, for example, look at the last row, is things happen for a very long time. So we've got accident quarters going from top to bottom. We've got development quarters going from left to right. And in this particular triangle, you had 1877 currency units incurred by the first quarter of development, and that had increased over a very long period of time of more than 50. Let's have a quick think over here. 5 years all the way up to development period 60, you can see that it increased to 16.5 million currency units. What we also have are the relevant premium amount, which tell you how much business was written in each one of these quarters, and this is something that you try to reserve. So what's different over here from this triangle from the one we saw before is in practice you won't have a square. You're only going to have a triangle, and your whole job is to predict that lower triangle so that you know what is your future expected incurred claims or future expected claims payments. But what's very nice about this is the example is because we know what the future claims payments are, we can test out some of our methods and come up with some more general guidance. This is a much shorter tail triangle. This is from a property book of small and medium enterprise insurance. And you can see it's the same dates, but things mature a lot more quickly. And that if you look at 2014 Q4, which is the bottom row of this table, we've hit 36 million after 9 months, and that's pretty much where it stays all the way through. So this is what's called short tail because it develops very quickly, whereas this triangle that takes a much longer time to develop is what's called long tail in the industry. So let's talk about the chain ladder method. The basic method for IBNR analysis is what's called the chain ladder method. And what this assumes is that the same patterns of claims development that you've seen in the past is also going to be observed in the future. So the general principle is if you saw previous cohorts where you'd pay 10 Rand in the beginning and that became 20 Rand after several years of development, then if you observe 15 Rand in the most recent period, it's likely to become 30 Rand after the same amount of development has occurred. And the way that you perform this analysis, you'll generally, if you look at the bottom part of the table on the slide, you'll see that you'll generally add up your claims happening in each development period. You'll derive what is the loss development factors. You'll see the first one is 1.468. That loss development factor and then enables you to derive a development pattern, which says what is the percentage development of a particular cohort of claims. You can see that the first figure is 71%. So the way that you'd read it is if you have 100 Rand incurred now, that's only 71% developed. So if you divide by 71%, you'll probably need 130 Rand of funds to pay for that total cohort. And this is basically the chain ladder. Just because this is a masterclass, I'm trying to throw in a few side notes on how do you practically use this. If you look at the loss development factor we have for the first development period, that's on the bottom left-hand part of the slide in the table. You'll see that the loss development factor we've calculated is 1.468. But if you compare that to the column of figures above that, you can see it starts off at 1.58 and ends in 1.54. You can see the 1.468 is actually lower than the most recent 5 development factors. And that the way you could compare that is comparing 1.468 to 1.54, 1.59, 1.81, etc. And what that tells you is you might have actually picked a loss development factor that is too low, and you might underestimate your IBNR. So always a good check to do is compare your loss development factors to the individual loss development factors and look for trend to make sure that you're not under reserving. So this is the outcome of a chain ladder analysis. After we've derived all of our chain ladder factors, we can make predictions of the future development for each cohort. And as we said, the easiest way to do that is you work out the percentage developed and use that ratio to derive 100% development for each cohort. So let's have a look at that on the right-hand part of the table. You know, I'm actually just going to see if I can find a laser pointer that might make everything easier. So if we just look at this table, here are the same accident year numbers that we've had before. So you can see there's 2014, which is what we were just looking at. Here is our development curve. You can see the first cohort is 71% developed. The number of claims that we had in the most recent period were 25 million. And when we project that using the 71%, that goes up to 35.9 million Rand. And that means that you need IBNR of the difference between those two of 10.4 million Rand. If you add all of this up, you get to a total IBNR requirement of 2.5 million Rand. So the big amount over there is offset by negative IBNR in all the previous periods. What negative IBNR means is you might actually have some recoveries. For example, if this was a motor line of business, you may be able to sell some of the wreckage of different vehicles, and that's going to bring money in through the door, and you can actually anticipate that with negative IBNR like we see over here. If you want to see that in terms of a graphical representation, here's our development curve. You can see we start off at about 71% developed, and you can see here's all the negative developments to get us back to 100% developed. Very important, something that you always should do when you're reserving is look at the loss ratios that you produce. These are your ultimate loss ratios, which are derived by taking your ultimate claims and dividing through by your premium. You can see that in the most recent accident quarter, we're reserving this to a 52% ultimate loss ratio, and that's sort of roughly in line with past experience, and that looks okay. You might be a little bit suspicious that this is exactly 50%. That's on purpose because all of these figures were disguised to make sure that no commercially sensitive information from the multinational insurer that gave us these triangles is given away. So that's the chain ladder method. So if we carry on.
Don, just a quick question in the chat. Someone asked, are these methods discussed here also applicable to IBNR claims, so incurred but not enough reported?
That is such an awesome question. So if you look at this triangle, this is actually an incurred triangle. And what you'll have at each cell of development is that you've got your paid plus your change in reserves. So in your first period, you'll have your opening reserves, your opening outstanding claims reserves, which are raised by your claims department. In the next period, you'll have that change. So when you project on an incurred triangle, you implicitly project both future payments and any shortfall in your outstanding claims reserves. So implicitly, this will also account for IBNR. If you want to get a separate estimate of IBNR from IBNR, that's, I guess, a little bit of a different topic, and maybe that's something we can talk about in a future a future masterclass. But what you do, if you want to derive that, the best way of doing it is something called Schnipper's method, where you have two different triangles. So Nida, I hope that answers the question, and if there's any feedback, we can come back to it.
Thank you, Ron.
Okay, so this was pretty much the introduction. Now let's start getting onto the actual topic of the day, which is moving from the chain ladder method to the Cape Cod method. So let's think about the chain ladder method itself, right? So there's two main parts to the chain ladder. You can see that we've got our observed claims in the most recent development period, and then we have this development pattern. So if you divide your development curve by 1, so there at 71%, if you divide that by 1 by 71, you get 1.3. Basically, the way you're going to get to ultimate is multiplying your most recent claims by your development pattern of 1.3. And as we said, what your estimate of IBNR is then is it's your current claims multiplied through by your development pattern minus your current claims again. So what you can see is that this process is very heavily dependent on the claims in the most recent development period, which are these light blue claims over here. But because these claims in the most recent development period are often highly variable, this means that your estimates of your ultimate claims likewise are going to be highly variable. So why is that that they're so variable? So it's very likely that as you receive more information over time, that you're going to start updating these estimates of your claims. And for long tail lines of business, even for your first year or two, your observed claims might be extremely small, and the development that you need to apply is extremely large. So if you just think about it, if this is a very uncertain number and very small, and this is a very uncertain number and very large, all of a sudden you're going to be raising a very volatile and variable estimate of IBNR that's not all that reliable. And this is why most actuaries, when they're reserving, are never going to use chain ladder for the most recent accident periods. They're going to use an exposure-based method. And the most famous way to do this is what's called the Bornheder-Ferguson method. And in this method, your ultimates are equal to three things. Your ultimate claims, as what is your observed claims in the most recent development period. That's the same as before. And then what we add to that is your remaining exposure. So what's the remaining risk exposure that still needs to develop? This is in this darker blue color. This is 1 minus your development pattern. So in other words, how much development is left multiplied by some sort of exposure measure. Most actuaries will use earned premium, and then to derive your claims from your premium, what you'll multiply through by is what's called an initial expected loss ratio, and this is the quantity in green. So if you want to calculate your IBNR using this Bornheder-Ferguson method, what you do is you get rid of the current claims, and then your IBNR is just your future estimated risk multiplied by your loss ratio. So what happens here, and hopefully this will be familiar to most of the people on the call, you're no longer projecting using earned claims, but you're rather projecting our expectation of the remaining development multiplied by some way of going from your future development to your expected losses, and that's the initial expected loss ratio. So how do we use and how do we derive the initial expected loss ratio? What you see in the market when people are setting this number is there's usually an ad hoc method of deriving our initial expected loss ratio from the data, and we'll see one ad hoc method of doing this now, or you can rely on your pricing team. And let's have a look at exactly what that looks like. So here's an example of the Bornheder-Ferguson method. So this is a very similar table to what we had before. Here are our accident years. Here's the premium received. Here's your latest claims, exactly like we had. Here's the same development pattern. And in fact, what we've done is we've got our chain ladder ultimate loss ratios in this column. What you could do, and what's often recommended, is you can take an average of the chain ladder ultimate. So you can see this is a weighted average over here. And this gives us a reserving loss ratio, an initial expected loss ratio of 57.5%. Then applying the same formula that we had before, this leads to a slightly higher IBNR number of about 11.6 million. So what I'm going to do at this stage is quickly run and get a little bit of water because my throat is very dry, and maybe we can use this very short break just to think of any questions. So just give me 1 minute.
Ron, are you there?
Okay, Sorry about that. I just needed a little bit of water. Okay, so what we now
We have a question, Ron. Maybe it's the right time to address
Yeah,
it.
let's take that.
The question is, how far should one go back in time to compare the link ratios to the selected development factors? And I think that was something you had, 2-3 slides back. Yeah.
So this is really the idea of comparing your selected to your experience. I think a lot of this depends on how long tail your line is and how much data you've got. If this is a very long tail line and this is a very small line of business, these are going to be very volatile. So you want to go back very far. If this is a very big portfolio and short tail, you probably can rely a lot more on these estimates in the most recent period. So for very short tail lines, I often will only compare to the past 3 or 4. I know actuaries in the South African market often like comparing all the way up to maybe 12 quarters or even longer. But my preference personally is when you're dealing with big lines of business is actually to give a lot of credibility to the most recent development factors. I don't know, do you have any thoughts on that, Nida or Karen?
No, I agree with you, especially where the experience is more stable. Like you said, for bigger lines of business, you would have very similar development factors unless something significantly changed in the claims management or handling processes. You would see that coming through. And then it would be important to take the change into account in the development.
Yeah, fully agreed. Okay, so now we have our Bornheder-Ferguson method. You can see the ad hoc method we applied to derive these loss ratios is just taking a weighted average of the chain ladder. But let's just think about this a little bit more, right? So for many lines of business, you're not going to be able to rely on your pricing team because often you won't have updated loss ratios because in, for example, commercial lines or on your net lines, often no one's pricing that. Or even if they are pricing, they'll also be performing a reserving analysis to derive loss ratios themselves. If you in a reinsurer with inwards reinsurance, that problem is even worse. What you could do is maybe look at your business plan. So a lot of people like looking at the company's business plan and looking at target loss ratios. But if you think about our requirements under SAM or if under Solvency II or IFRS 17, you need best estimates. And it's very difficult often to guarantee that your target loss ratios in your business plan are best estimate. A lot of times they're more optimistic. So what we've done over here is use an ad hoc derivation. So we've just taken an average of the chain ladder in the last 4 quarters, but this is quite hard to justify to other people. So it might make sense to you as the reserving actuary, but when you need to justify to your auditors or your regulators or any other reviewers, why did you only pick 4 quarters? Maybe you should have picked 8. Or maybe you should have used a simple average instead of a weighted average. So this becomes very messy in practice. And a lot of people in the reserving process spend a lot of time having to justify your initial expected loss ratios. And this is the last pit stop on the way to the Cape Cod method. So what the Cape Cod method is it's a principled way of deriving loss ratios from reserving triangles. And this is really what we're going to be discussing in the rest of the presentation. So the Cape Cod method is due to Hans Buhlmann and someone else called Straub. They wrote this paper in 1983. And why does it have such a funny name? So Cape Cod is actually a place in the United States. You can see on the bottom left-hand part of the slide, it looks very nice, so maybe a good place for a holiday after you finished your reserving. And when I was at the Insurance Data Science Conference in 2019, Hans Buhlmann told me the story of where this method came from. So he was working for Swiss Re at the time, and Hans Buhlmann has invented half of modern actuarial science single-handedly. And the actuaries at Swiss Re from America came to Switzerland because they were having a lot of trouble with their reserving. Here's Hans over here. And in payment or in to compensate them and say thank you for all the help they'd given, they invited the Swiss actuaries over to Cape Cod in the United States. And when they met there, this is where they actually discussed and went through this Cape Cod method. So this is the story of where the Cape Cod method comes from, as we heard from Hans Buhlmann. Or as I heard from Hans Buhlmann a few years ago. So that's why it's got such an interesting name. And really what the principle of the Cape Cod method is this idea of credibility. So credibility is a fundamental concept in the work we do as actuaries. This is how much can we rely on data that we see, whether it's in pricing or reserving or whatever other field we've got, how much credence or credibility can we give our data compared to the prior knowledge that we might have about a particular line of business. And let's just give a simple example of credibility. Let's say we are looking at a motor triangle, and we see in the most recent period that the implied loss ratio is 120%. We might say, hey, that actually makes no sense to us because we know we've priced this line at 60%. It usually runs at 60%. So there's some sort of noise or outlier over there. So we're not going to give that much credibility. However, if you are looking at an older accident year that's almost fully developed and you know there's not going to be any changes, and here you see 55%, in that particular instance, what you're going to say is, hey, this is fully developed. We don't expect any future changes. And here we can give it 100% credibility. We don't need to downweight the data and apply more judgment or more of our prior knowledge. So what this exactly tells you is that when you're looking at a reserving triangle, one direction of increasing credibility is in the direction of the development axis. As your estimates have developed more, you're going to give them more credibility, and as they've developed less, you're actually going to give them less credibility. So what this means is that your more developed accident years are likely to provide better estimates of ultimates. And from this, you can see and understand the problem that we've been mentioning with the chain ladder is that the chain ladder gives 100% credibility to the most recent accident period. It takes this estimate you might have at face value, and therefore that's exactly the problem around variability, particularly if there's a lot of development or it's a very volatile line. So what is the Cape Cod method? The Cape Cod method tries to calculate your initial expected loss ratio from your triangle, but by applying credibility weighting. So you weight your estimates of ultimate, and this is in the light blue, by the extent of development according to the chain ladder method, and this is in the slightly darker blue. So you work out your initial expected loss ratio using this weighted average. And if you multiply these two things together, if you remove the development from your chain ladder ultimates, you get back to this little formula at the bottom, which says your Cape Cod loss ratio is the sum of your current incurred claims estimates divided by your earned premiums multiplied through by the percentage development. And that's left over from the original weighted average. So what the Cape Cod method is, it's a weighted average loss ratio where your weights are derived using the percentage of development, and the percentage of development to that point really shows how credible or how not credible a particular claims estimate is. So hopefully that's clear, and if you've done a little bit of other actuarial work, what you'll probably have come across at some stage are other applications of credibility theory as well. For example, if you're pricing big fleets of business, fleets of motor business, you'll often use credibility theory there. So this is really, Cape Cod is a credibility weighting of your loss ratios and of your claims experience in a triangle. It's quite apt and quite sensible that Hans Boelman invented a credibility weighted average, because if you've done this work in some other parts of actuarial work, you'll know that we often use Boelman-Straub credibility, which is the method developed by Hans Boelman for pricing as well. Okay, so let's apply the Cape Cod method. This is exactly what we had before. Up to here, we've all seen, here's your chain ladder method, here's your chain ladder IBNR of 2.5 million rand. And now what we've done is we've applied this credibility weighted Cape Cod method to derive a different estimate of your initial expected loss ratio. You'll see that it's constant over all years, and this produces a slightly higher estimate of IBNR of 2.8 million rand, and not particularly different. So the next question that you could ask, and hopefully someone in the audience will be thinking this, is how reasonable is this assumption of a constant loss ratio over time? You can see we're keeping a constant over accident years. And if you've been in the insurance industry for more than a year, you know that this really isn't realistic. Experience basically varies every single year. You could maybe say, let's vary the number of accident years that are included, but that again leads to a lot of judgment. And the question we'd like to ask is, can we automate the process of how much weight to give to these older accident years versus the newer accident years? And this is the final place that we're going. This is now the generalized Cape Cod method, which is from an actuary whose name is Spencer Gluck. He's been working at AIG for the last couple of years, and he wrote this really nice paper in 1997. And his point is, one direction of increasing credibility in a triangle is from left to right, but another very important dimension of credibility is how closely do the more recent accident years, or how far away are you from the accident year that you want to reserve from? So in other words, if you're in this most recent accident period, looking back 15 years is not going to give you much information. So from the perspective of this accident year, these old accident years actually should have lower credibility. So not only are we weighting our estimates of ultimate by the extent of development, we're also going to weight them using a measure of the recency of information. This is called the weight factor or the decay factor. And you can see that basically what it does, and we'll have a few graphs of this in a little bit, this basically gives you a weighting of how far away are you in the most recent accident period, that might be called J, from a previous accident period, which we could call I. So let's just think about this a little bit. Let's pretend that this factor is actually very close to 0. So that means that the only factor that will be high is the current one. So if you push this weighting factor all the way to 0, then you reproduce the chain ladder method. If you push this factor to 1, so we know 1 raised to anything is still 1, then you give the same estimates to all prior years, and therefore that reproduces the original Cape Cod method. So let's just get a little bit of intuition over here. These are, what is this exponential weighting that we've been discussing with just this formula over here with respect to different accident years? And I've chosen a few different weights. Here's 10% going all the way up to 100%. You can see that the very small weights give a lot of weight to the accident years immediately nearby, but that weight drops off extremely quickly and is giving no weight almost to the prior accident years. If you're going to choose something very close to 1, then you're going to give equal weight to all the prior years. And if you choose something like 95%, that means you're going to slowly trail off. So you'd rather give more weight to the more recent accident periods, but you're going to give less weight to the, but not, that's not going to drop off dramatically. It's going to give a little bit of less weight. And you can see that as you move from something small to something closer to 1, you get this pattern. If you think about this from the perspective of the most recent accident year in the triangle, let's just look over here. So we were looking somewhere in the middle before, now let's look over here. You get a very similar pattern, but in this case, you don't have any future accident years, so it's almost like cutting this halfway. So if you've got a very low number, you're going to look at the most recent accident year and maybe 1 or 2, but anything older than that, you're giving 0 weight to very quickly. If you're giving everything equal weight, then you're going to weight all of your years with the same weight. And if you give it something intermediate, like 75%, it's going to drop off pretty quickly, but you'll still give some credibility to these years over here. And this really is what we were saying before. For a very low number, you get back to chain ladder because you give all the weight to the current accident period. If you go put this weighting parameter to 1, then you're going to give equal weight to all periods. And then something in between gives you this nice mixture between chain ladder and the original Cape Cod method. So let's have a quick look. This is the liability example that we were mentioning before. I've chosen a weighting parameter of 80, and we'll see why I chose 80 in just a little bit, because this actually turns out to be quite optimal for this triangle. You can see here is your initial expected loss ratio. You can see that there's some trend. We start off reserving at about 33%. Things have gone a bit pear-shaped. We've gone up by almost 11 points on the loss ratio within about 3 years, and then things are coming back down. Maybe the reason things are coming down is there's been a rate increase or just experience has been better. So you can see the chain ladder IBNR is 18 million. Now over here for the Cape Cod, it's 20.1 million. And you can basically see that the Cape Cod method is picking up on more of the trend and reserving at a significantly higher number than the chain ladder. Chain ladder would reserve this to an ultimate loss ratio of 25%. Now we're reserving this to 36%. And this very nice smooth progression of the loss ratios also reflects something that we like to do as actuaries, which is say that things should be smooth. You don't want these big jumps, whereas in the chain ladder, you can see you've got all these kind of quite horrible jumps. So that's the generalized Cape Cod method. And what I'll just say, maybe let me stop sharing the PowerPoint. Hopefully this isn't going to break anything. Let's share a workbook. So we've put together a workbook with a couple of these examples, and I'm very happy to share this with anyone who's interested, obviously without any sort of warranty or guarantee or fitness for any purpose. But what you can see over here is how your IBNR changes as you might start modifying this percentage. And this is a very typical sort of workbook that you might come across. Okay, so let's see where we go from here. So we've seen the Cape Cod method. And what you can also see, this is something very interesting, is how does your Cape Cod loss ratio compare to your chain ladder loss ratio? So here we've got a weighting parameter of 80%. Here we've got a weighting parameter of 30%. Obviously, your chain ladder is staying the same because that doesn't depend on a weighting parameter. You can see your chain ladder is highly volatile and a little bit crazy, very difficult to see a pattern with this nice smooth loss ratio produced with a weight of 80%, which is exactly what we saw before. You can see you've got this nice smooth progression, and this is really interpolating between your chain ladder loss ratios in a very nice sort of way. If you make this 30%, you can see we've now gone a little bit too far and it's maybe, excuse me, a little bit too spiky. So basically another thing to remember is your generalized Cape Cod method interpolates between your chain ladder ultimates in order to give you a nice smooth loss ratio. And that's a nice way of thinking about what we're looking at. So let's talk about a couple of rules of thumb. As we've been seeing, you need to choose only a single parameter. So a lot of your judgment has been reduced. You only need to justify why you chose 80% or 30% as opposed to Bournehead or Ferguson, where you need to basically justify each one of these and why the method you chose is appropriate. So we've kind of reduced your judgment down to a single parameter. Here's a couple of rules of thumb. How should we use the generalized Cape Cod method? So what we've seen is that the weight parameter determines how much weight to give to nearby accident years. For very volatile lines of business, it's very difficult to get a clear signal from any particular accident year. This implies you should use a higher weight parameter. If it's a bigger line of business, that means there's probably more signal, then you can use a lower weight parameter. For more granular triangles, like quarterly triangles as opposed to annual triangles, you'll need a higher weight parameter because there'll be higher volatility. If there's a stronger trend and you want to give more weight to that stronger trend, you should actually use a lower weight parameter. This is wrong. Sorry, guys, I'll change this before we post the slides. Should use a lower weight parameter because a lower weight parameter will be more responsive in the case of a stronger trend. If you're looking at count data, you can use a low weight parameter because count data is nice and stable and not volatile. As soon as you introduce severity, which is both if you're looking at a severity triangle, but also if you're looking at incurred or paid data, you need a higher weight parameter. And a really good rule of thumb is start at 75% and then play around, maybe take this up to 95, maybe take it down to 50, and you can see from there. So we've seen how to, oh, Nida, yeah, you want to go for it?
Sorry, we have a few questions, and I think this is the right time to address some. I think this slide sort of addresses the question we have, how does one choose these weighting parameters? So you have given some options and justification for it. The other question we had is, from James, are there any business lines that are sensitive to different reserving methods? And I think with that, you can also address this question. Is Cape Cod then more applicable to longer tailed business classes?
That's a great question. I mean, so I don't think the Cape Cod is, I don't think the generalized Cape Cod is a method. The generalized Cape Cod is a principle. And that principle can lead you back to the chain ladder method. This is effectively the chain ladder method, or it can lead you to a very stable, longer term reserving method, or anything in between. So I view the Cape Cod method as a principle that spans across multiple actuarial methods. And what that means is generally you'll find that it's more optimal to reserve with a generalized Cape Cod of 10% than a chain ladder. And I'm willing to bet for most triangles in the South African insurance market, that'll be the case. Is that even if it's a very short tail line, you're better off using a little bit of Cape Cod than pure chain ladder. Obviously, guys, please, I'm not giving sound actuarial advice. Please don't go and blow up your insurance company by reserving everything at 10%. You must ask, you must apply your own mind and then ask your HAF, and then ask all your other actuaries you can get hold of as well. So I'm just telling you a rule of thumb from my experience. So in answer to the other question, this is very good for long tail lines of business, but it's also very good for short tail lines of business. And as I say, I don't view it as a particular method. I view this as a continuum of methods that interpolates between the classic method of chain ladder and the classic method of the normal Cape Cod. So Nida, I don't know if that's clear. I'm just trying to make sure no one does any damage to their balance sheet, but that's my view.
It's clear. The other question we had was, do you use the incurred triangle or paid triangle to derive the development factor per cohort?
So generally, if you've got incurred and paid data, the recommendation you normally see is do both. Then divide your incurred by paid and see what's happening, or paid by incurred. If you don't have time to do all of that, you just really need to understand. If you've had a big change in underlying reserving methodology, you might be better off looking at incurred. If you've got not such a big change in reserving methodology, then incurred might be better. So it depends a little bit on your knowledge of your book of business and what you see. Okay, anything more?
Thanks, Ron. Yeah, there's one more question, a bit different to what's being covered here, but I think it's a worthwhile question to address. The person has asked, what in your opinion is the best way to review another actuary's triangles? This could be in the context of HAF or audit work. Naturally, there's a lot of judgment in terms of methodology use, link ratio selection, priori assumptions, etc. And this person has seen some actuaries use a range, but the range is so wide that it defeats the purpose. So Ron, what's your view on this one?
So I would always personally, because I like the generalized Cape Cod method, and that's why we're giving this masterclass, I would just, if you really want to see your own view, quickly knock up your own Cape Cod and see at what parameter setting can you reproduce the estimate that you're reviewing, and at what parameter setting can you reproduce the range that you might have been given. And that'll tell you a lot about, is it closer to chain ladder? Is it closer to a long-term view? So I would just really use this method. But I mean, that's a very general question, and maybe what we should do is get a very experienced HAF or other reviewing actuary in to talk about this sort of thing for our next masterclass. Okay. So let's now talk about modifying the Cape Cod method. So what are the two main assumptions embedded in this generalized Cape Cod? One is that each year is actually a relevant contribution to your estimates. And the next one is that your premium basis is on the same rate. Let's talk a little bit about more of this. When could you violate assumption one? If you've got a particular year where special events occurred, then each year may no longer actually be relevant to your estimates. So think of COVID-19. If you're trying to reserve for 2020 Q1, you're going to, or Q2 even worse, you probably want to exclude that going forward. And anytime you've got unusual experience, maybe things are too good to be true, or maybe it's too bad to imagine happening again, you might want to deal with that violation of assumption one. The next one is that the premium basis is on the same rate. If I'm charging you 1,000 Rand for R1 million of cover, then the loss ratio you'd expect to see is very different than if I'm charging you 2,000 Rand for R1 million of cover. And often you'll see that your premium basis may change due to repricing or just the market hardening and softening, and meaning you can get a different premium rate out there in the market. So let's have a quick look at how you can modify the Cape Cod for each of these. So if you want to fix assumption one, you can put in some indicator variables, and these indicator variables can be 0 or 1. And if it's 0, you're not including it neither in the top nor in the bottom. And if it's 1, you are including a particular accident year. And that's a good way of sorting out things going wrong when a year is not relevant. A different way of sorting things out for assumption 2 is actually including a rate index only in the denominator of the Cape Cod. And this restates your premium base using a rate index. And let's have two very quick looks at how this could happen. So in this particular case, we want to look at modification 1. We're still using a weighting parameter of 80%. And what we've done is we said all of these amazing years where your chain ladder ultimate is less than 30%, that's just too good to be true for the current market. In these cases, we've excluded these particular years, and you can see when you recalculate the Cape Cod, all of a sudden you've got a step change up of about 5 points. can see this leads to significantly higher IBNR. This is always a very good thing, especially in South Africa after having a totally messed up year with COVID. If you're reserving a motor line, you probably need to exclude these, and here's a very nice automatic way of doing it. Let's say you have a rate index, and we're talking about modification 2, where you basically expect your rate to have changed by 6% per annum. So what you can do is you can build up a rate index like we've done over here, and then this is going to modify your Cape Cod. If you think about this, what is a rate index of 1.3? That means that a rand of premium that you had before is now equal to R1.35 now. So if you put everything on the same premium base due to this rate index, you can see that your Cape Cod loss ratio, both the trend and shape has changed, right? What you then could do is re-reserve your, you can re-reserve using this modified Cape Cod, this modified Cape Cod loss ratio. And that's going to give you a slightly different IBNR estimate after you reweight things. And that's quite important, particularly in the current market in South Africa, where you might have changes in your prices of insurance cover. Always just think about should you have a rate index. So there's much more emphasis on rate in North American actuarial practice. It's not something we often talk about in South Africa for some reason. How can we define rate indices if you haven't been tracking these? Quick and easy is look at the sum insured information you've got in premiums, derive rate in each particular accident period that you want to reserve for, and you can build up a rate index from that. If you're not interested in working with rate and you know there've been big moves in the market, maybe don't use earned premium as your exposure base. Maybe use, if you're looking at motor kilometers driven from a telematics device, as a different exposure base. Okay, so now we've seen how to modify the Cape Cod method. Let's talk about probably the most important thing that you can ever do in a reserving exercise, which is checking, did we get it right? So all IBNR reserving is nothing more than trying to predict all of the next diagonals of your triangle. So what you need to do is monitor how well are your models performing against your emerging experience. And when you need to, you can adjust your models to make sure that maybe we'll get it right the next quarter. Right? In IBNR reserving, there's two main concepts of tracking your did you get it right. One is comparing your actual claims experience next quarter, that's on the yellow diagonal, together with what you thought it was going to be. That's called actual versus expected, or AVE. There's another one that actually underlies reserve risk in SAM, and this is you take your actual versus expected and you add on the change in your reserve estimates for the lower triangle. So let's say you reserve at year end, 3 months later, you still need to hold a new IBNR reserve for all of the old accident years that you reserved for at year end. So your claims development result is really your actual versus expected plus your change in IBNR for this green triangle. So these are two ways of asking, did we get it right? So let's look at actual versus expected analysis. This is the simple way of deriving this for the Cape Cod, but this also works for Bornhead-Ferguson. You really look at what is your percentage developed at the next development period minus the current development period times by your earned premium times by your initial expected loss ratio. We've done this for the liability triangle, and you can see that things have not worked out so well. We expected 5.7 million rand, and we actually got 9.7 million rand of development, so we were 4 million under. So this is a problem, and another thing to look at is where's this coming from. You can see that we have quite a significant amount of underestimation in the old accident years with respect to 2014, and this is definitely not something you want to see with long tail lines, and should make you stop and think, hey, we need to chat to our claims department, we need to chat to business, we need to chat to our HAF and try to work out what's going on. So another key metric is if you keep everything constant and you calculated a Cape Cod loss ratio, and now the next quarter you recalculate your Cape Cod loss ratio, another good thing to look at is, hey, how did your Cape Cod loss ratio move? So what you can see, you had higher actuals than expected, which means overall your claims experiences got worse. Whenever that happens, your Cape Cod loss ratio is going to move up. And in this particular instance, you can see it's moved up by 3 or 4 points. And that's quite hectic on a long tail line where you wouldn't expect 1 quarter of experience to dramatically change your views on anything, So this tells you, hey, this was a pretty big miss and we need to do something. So what we said is another way of looking at this is your claims development result analysis. So your claims development result is your actual versus expected, plus the change in IBNR for older accident years. And if you do a little bit of thinking, you can see that this is also the same as the change in ultimates over the time period. Why we care about the claims development result is this actually is what comes through in your income statement. So what we did over here is we held our development pattern constant. We have re-reserved the IBNR. So this is your IBNR at time t plus 1. We've re-reserved this using your new implied Cape Cod loss ratio. We've derived a new set of IBNR. And we also know from the previous quarter, what did we expect our IBNR to be? So you can see that in total, we've gone from 15 million rand, from 14.4 million rand to 15 million rand. So that means we also have a loss of 584,000 rand, or currency units, because this isn't in rand, in addition to our actual versus expected loss of 4,000 rand. So you can see if we just break our claims development result down, it's 584 due to change in IBNR, 4,035 due to our actual versus expected. So our total income statement miss is actually going to be 4.6 million rand. And this is a good thing to track. If you keep tracking this for a long time and take the standard deviation, this is exactly the reserve risk parameter that you need for reserve risk in SAM. So that's another nice reason to track this. You can get an estimate of your insurer-specific parameters from this. Okay, so we've now looked at two ways of looking at actual versus expected. Let's talk about a practical question. Are there more exact ways of setting the weighting parameter or the decay parameter that we're using in our Cape Cod method? So what you can do if you've done a little bit of machine learning is you can think of this as a hyperparameter. And a hyperparameter is a parameter you can't derive directly from the data, but you need to set this using some sort of other metric. So for example, how well does a particular hyperparameter setting work on predicting your triangles over time? So the main proposal that we're going to give here on how can we answer this practical question is use your actual versus expected, your claims development result, and your change in initial expected loss ratios to derive an optimal setting for this hyperparameter gamma. So we're going to look at two ways of doing this. One is just track this on a quarterly basis and see what optimizes your results over time. Or another method, which we're going to briefly look at, is you can use an actual machine learning approach that uses past data to optimize this parameter. So what are the things we're trying to do? We want your actual versus expected and claims development results to be as close to zero as possible. And if you keep getting these at zero every quarter, it means your IBNR is at a best estimate versus the emerging experience. And we also want the change in your loss ratios to be as small as possible. And this really means you don't want your chain data loss ratios to be bouncing around all over the place. You want to maintain your expectations as much as you can in the face of emerging experience. So let's have a quick look. And here what I'm going to do in the workbook that we're happy to share. Here's the liability example. And what we've done is we've re-reserved the next quarter. And what you can actually see is, well, how would your actual versus expected have changed? And here's your AVE if, say, we had reserved using the chain ladder method. So that's going to be your chain ladder method, and you can see your AVE's gone up. Let's say we'd reserved using a very stable Cape Cod. Your AVE's now gone down. And if we just tabulate all of this back in the presentation, what you can see is something very nice, that for this particular line of business, this is what would your AVE have been at each of the different weight parameters. So you can see this, you minimize your actual versus expected for one quarter at a parameter of 80%. And that's why throughout the presentation, we've been working with 80%. You can see some other very interesting things that at a weight parameter of 80, you'd almost have minimized your claims development results as well. So that would give you the smallest increase in IBNR. And then this is just how much, it's a measure of how much your initially expected loss ratios have varied over each parameter. And you can see this is strictly decreasing. And we'll see why this is important. Here is just a graph of all of the different combinations of weighting parameters. So from left to right is your decay parameter. here are your different accident years, and you can see as you have a higher weighting parameter, you get these nice stable loss ratios and you don't get all this noise. What you can see over here is actually chain ladder gives you a very unstable set of changes, and we don't like changing our views too much. We actually would prefer something much more stable. And in this particular line of business, you want to select something quite high. Let's look at that SME line of business that we had before. Here, what you see is what minimizes the actual versus expected or brings it close to zero. You could have used chain ladder. You could have used 35%, which is quite reactive. And you actually could have got away with using 95%, which is quite stable. In terms of your claims development result, that indicates something 35 or 40%, also 95% isn't bad. And then if you look at how does this loss ratio, how do your loss ratios change? This is strictly decreasing. And you can see that this is very stable at 95%, but maybe it doesn't give enough weight to your trend. So probably in this example, I would pick something like 35 or 40% for the weight parameter. So that's method one. How can we do method two? Method two, there's a very nice Python package based on a paper I wrote with Cesar Bologna in 2020. And this was implemented by Cesar, and it's all open source in what's called the triangle package. This is in Python. And basically the recipe is very similar to what we did. You select an initial triangle, you then add on some diagonals, and you keep tracking how does your actual versus expected and claims development result vary as you change your different parameters. So what I'm going to quickly do is show you what this looks like in Python. And thanks so much to Kovlin in the actuarial control function team at Old Mutual Insure who did put this workbook together. And let's just quickly run through a little bit of the Python. Here's where you get all your packages. Here is the same triangle that we've been looking at. We can triangulate this over here. Hopefully this is a little bit familiar from the presentation, and besides for adding a couple of columns, this is indeed exactly what we've been looking at. You could reserve this using the Cape Cod method, using the chain ladder package. That's going to give you your link ratios. It's really, really nice. And if you reserve this, you can actually get your IBNR out. The reserving here was done using Cape Cod with a decay of 80%. And here's where the magic happens. Let's define all of the different hyperparameters we want to tune. I'm only going to talk about this one. This is how much decay, what is your decay factor you'd like to give. Here it's 80%. We do a little bit of definitions that we want to look at the Cape Cod method, and we run this line of code, and in about 1 minute it spits out its results. And the optimal model that it found is with the Cape Cod parameter of 80%. And you can apply the same workbook, which we're very happy to make available to anyone who wants it. You can apply the same methodology to optimize your Cape Cod parameter, or quite honestly, any reserving method that you've got using the triangle package and the methodology we've been discussing. So that's quite nice, and that gives you a real data-driven way of selecting the parameters that you can say to anyone who wants to know this has been derived using the past data and is likely also to be good going forward into the future. If we re-reserve this using the Cape Cod, here's the IBNR that you get. So what we've done today is we've been on a long journey all the way from what is short-term reserving all the way to quite advanced methods of applying the Cape Cod. We've seen how to modify this for interesting issues like changes in rate and unusual years. We've said the most important process you can apply is actual versus expected. You could select your GCC parameters using these metrics, and you can track this over time or optimize them. And one thing we haven't discussed today is how can you allow for different development patterns. This is a big problem in practice. We've assumed throughout that your development patterns stay stable. That's not actually the case. And this is a very interesting research question that would be worth working on. Here are all of the references that we've cited today. All of these are actually available for free. And the really brilliant package that Cesar Bologna put together is available at this link over here, in case you'd like to try optimize some of your own triangles. And with that, Nida, let me hand back and let's see if there's any further questions.
Thanks, Ron. There is one question. How well does Cape Cod perform in an inflationary environment?
So ideally what you do in an inflationary environment is allow for inflation explicitly, but if you don't have a good way of doing that, for example, if you don't have a good inflation index, which is very difficult in the current South African environment to find, then Cape Cod's a very good bet because it's going to automatically take trend into account. Probably what you want to do is adjust your your premiums for rate, because if you think about the current environment, everyone's pushing through rate increases. So you need to restate your premiums to be on the same level. Once you've done that, Cape Cod might be your best bet, actually. That's my view.
Yep. Another question we have is, are regulators particular with any of these methodologies or any preferences that they have?
That's a really interesting question. I've never heard a South African regulator express an opinion on this. I'd very much like to hear from the audience or from anyone here if they've heard differently. In the UK, the practice seems to be to use Bornheder-Ferguson with the sorts of ad hoc selection of loss ratios that we've seen. In the United States, the Cape Cod is a lot more popular. So I think it's driven by territory sometimes. And hopefully after this masterclass in South Africa, Cape Cod will also become a bit more popular.
Thank you, Ron. I don't see any new questions. Yeah, those are all the questions. Any comments? Any last words, Ron?
So yeah, just thanks so much to everyone for attending. We really hope it was useful. There's an email that's been posted where please provide us with feedback, and if there's any particular masterclass anyone in the audience would like to see next time around, please let us know. And also, if anyone would like some of the workbooks, we're happy to make them available after the talk. So Nida, thank you for chairing, and back to you.
Thanks so much, Ron. Like Ron mentioned, the email address is actuarialcommittee@ominsure.co.za. So if you're interested in receiving the slides, model recordings, please send an email there. Since there are no further questions, I will then be closing this off. Thank you, Ron, so much for this insightful presentation. And thank you to everyone who posted their questions and for your participation, which made this session really engaging. We do look forward to seeing you at the next event. Have a good day further. Thank you. Bye.